Is there a way to trade earnings regardless of market direction? And the answer is yes. All right. This is something called a straddle. So I want to show everyone how we can build a straddle. And I'm going to build a straddle right now on a stock. I don't want you to do it. This is an example. Example for those of you who've never done a straddle before. I'm going to show you how to do one right now. So I'm going to take a chart. Let's look at Walmart. That's a good idea. Okay. Even though I don't want to trade a straddle on it because it's going to be expensive. That IV up here is expensive. But I want to show you how to build a straddle. What is a straddle? A straddle is a combination trade. It's an at-the-money call and an at-the-money put using the same strike price and the same expiration date. Now I'm going to build one right now using Walmart. So let's look at some option chains. Now, if I were to build an at-the-money call or an at-the-money put with Walmart using this Friday's options, it's going to be relatively cheap when you look at the price. But it's not going to be cheap in terms of implied volatility or option premium. Right now, I have the last price of Walmart at $133.39. The 133 calls and puts, these are going to be the closest to the market right now. That's why we call them at the money. At the money means the closest to the strike price. So here's my at the money call and here's my at the money put for February 18th. If I put those together and I buy the call and I buy the put, how much is that going to cost me? Let's find out. So if I were to do that, and this is only a 2-day trade, which is one big reason I don't want you to do this. And again, it's just an example of how to build one of these. I'm going to give you a straddle on a better name with a setup. All right. That's going to happen soon. But right now, let's take a look at this 2-day trade, $572 for 2 days, between now and expiration. What are we doing? Well, this straddle involves the Feb 18 133 call, which is trading around 305, and the Feb 18 133 put, which is mid-priced at 267. You put those two together, and you're talking about a trade that's going to cost around $572. It's $5.72 for the trade, but then you take that number and you multiply times 100 because the contract is good for 100 shares of stock long and 100 shares of stock short. The long is the call side, right? The short is the put side. You add those together, and what you have is a trade that if you were to graph it, it looks like this. So what this means is if Walmart were to go up, the calls would outpace the puts, and you could stand to make money. And if the stock price were to go down before Friday, the puts might outrun the call options. Because again, what do we know about buying calls and buying puts? We know that if I buy a call, the worst case scenario is I lose the premium. If I buy a put, the worst case scenario is I lose the premium. But if I buy a straddle, the worst case scenario is I could lose premium on both sides. The worst place that Walmart could be on Friday at expiration is $133 because at $133, your call is worthless and your put is worthless. But at $138, okay, or let's make it $140. At $140, where are we? Well, the 133 call is going to be worth 7. The 133 put's going to be worth 0. So if you paid $5.72, all right, or $572 for something that could be worth 7, that means your $572 investment could be worth $700. But in order for that to happen, Walmart has to get to 40. All right. On the downside, Walmart would have to get to $126. At $126 to the downside, the puts would be worth 7 because, again, you have the right to sell at $133. That gives you a $7 intrinsic value on those puts. The calls would be worth 0. So do you see why I show this as a non-directional trade? What has to happen is Walmart has to get up and go somewhere before Friday at 4 p.m. Now, you only have 2 days for that to happen, being today is Wednesday. So this is not a high probability trade. In fact, you want to know how low probability this trade is? Well, I have that data too. You see that? The computer is saying 0% chance you're going to make money on this trade. Now, it isn't 0%. There's a fraction in there, but it's less than a 1% chance that this trade has any ability to make money. All right?
I don't like those odds, Tom.
Yeah, I mean, and the reason it's so low is because the price of Walmart is so high. Now, you might say, some of you might go out there and say, "Well, Tom, why don't we sell that straddle?" Because there's always that fractional, that 0.001% chance that Walmart could jump up or Walmart could get caved down, and then all of a sudden that straddle goes into money, and you don't want to be on the sell side either. Again, I said that this was an example of how to put a straddle on, but it's definitely not an example of a straddle that I would want to buy.